Bang ding ding, trademark. He come out 6'7" tall. Bang ding ding, one is star. Bang dong ding dong ding dong ding dong ding dong ding dong ding. It is a perfect day.
Woke up to the sound of the garbage truck again. Upstairs neighbor's toilet's leaking on my head. Cars broke down, I missed the bus, there runs a 10. I had a feeling this was a day to stay in bed. I finally left my pad right on the jumbo's cloud roof. A police officer pulled out his gun and said, I said, sir, you got the wrong guy. I guess it's just a perfect day. It's just a perfect day. Na, 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 na,
Hey everybody, welcome back to Eggs. This week we have John Stoj. John is likely the only investment advisor you've ever met who has managed both $3.5 billion and a sushi kitchen. John's career in finance began on a Wall Street trading floor over 25 years ago, with stops at an investment and commercial banks along the way, even his own hedge fund. This uniquely prepared him to see the financial services industry for what it is, that's flush with companies and professionals who are far more focused on their own best interests than their customers. John believes sincerely that done well and delivered fairly, good financial advice is more valuable than its cost and worth buying. Unfortunately, through his experience, he knows that banks, broker-dealers, insurance companies, etc., do not have their customers' best interest in mind. They have their own. On top of that, John brings to the table experience opening, running, and selling a small food service business. Nothing breaks you out of the shackles of Wall Street than a small business ownership on Main Street. Here to talk about that and all that's happening right now in our world is our special guest, John Stoj.
Oh, thanks, guys. I really appreciate it.
Yeah, not a problem. Thank you for making the time for us. We really appreciate it. You want to go back to the beginning and kind of tell us where you came from and how you got into the financial world and how you got into sushi, of all things?
Yeah, no, it's I've got kind of a convoluted story, or a story that starts out extremely boring. I sort of was the geek. I didn't become an Eagle Scout. That was the one thing I did not do. So I can't hold that up to y'all. But I was a Boy Scout, and I just played by all the rules growing up. Went to got good grades in high school. Went to college. Got a call one day when I was home in the summer before senior year, and one of my friends had been working in New York City at a Wall Street firm, and he said, "Hey, what are you doing this afternoon?" I said, "I don't know. I think I'm going to see if I can find a job for the summer." And he said, "Hey, can you be on the train into the city and be here by 1?" And I so I managed to do that, and I got a job. I got that internship that summer, went back to work on Wall Street, went to get my MBA, got out, went back to Wall Street, worked for 10 years. All that kind of stuff just went along fine. And I learned a ton. It was great. And then there was the financial crisis. And so I'm really compressing this story because of a lot of the details anybody could talk about sort of now, but it feels like we're recording this episode during the whole COVID pandemic, and so it feels a little funny to talk about how I made my first $10 mowing lawns or something like that. But that led what happened was we had the first financial crisis 10 years ago, and that put me out of work a couple times in a row in terms of my finance career. Started a money manager 6-7 months before the crisis hit, and that put us out of business. Luckily, we hadn't put anybody's money to work, so we didn't lose anything for anyone by that point in time. Then a friend of mine, a partner of mine, and I, we started a hedge fund. We had $300 million to put to work. investing in distressed assets, because by that time we were looking for assets that had gone down in value because of the financial crisis. And we were about to put our first $120 million to work when the banks were bailed out for the last time. And the next day we got a call saying, well, you know what? We don't need your money anymore. We got Uncle Sam's. And guess what? Uncle Sam's money is a lot cheaper than hedge fund money. So that put another company out of business of mine. And I just was fed up with the whole thing. So I wanted to do something different. And I started thinking about what kind of businesses that I could open. And there's a reason why a lot of people open restaurants and food businesses, food trucks now and things like that, because of the barriers to entry are pretty low for those businesses. And so I went for it. And people ask me, well, why did you do a sushi restaurant? Do you love sushi? Is that your favorite, your passion? And I don't really eat sushi. I eat a little more. I do prefer my food cooked. So I don't even care for beef tartare. But I did have another friend from business school who had started a little sushi grab and go company that he always said he wanted to become the Taco Bell of sushi. And I told him, okay, well, that's not the worst idea in the world, but why don't at least maybe you want to become the Chipotle of sushi? It's just an idea.
Well, we actually have this restaurant in Salt Lake. What's it called, Ryan? They do these sushi burritos almost.
I think it's just called sushi burrito. Yeah, they're just basically a hand roll, but they're a giant burrito-sized sushi roll that you can just nosh on. It's actually pretty awesome. I think they're just called sushi burrito.
That's your Taco Bell sushi.
Yeah, there you go.
Things right there.
There you go. And that was so. This is 8 to 10 years ago, and we were seeing stuff like that, and that was one of the things we wanted to add to our menu. Eventually, we never did. But I said, okay, well, I'm not going to open a restaurant because I'm afraid of just turning the lights on and nobody's going to walk in the door. And that made me nervous. So I said, well, how can I do this business in a way that if I plan it methodically, I can create a business that I'm comfortable running, and two, something that I can sell later on. And so I decided, I went into business with this friend of mine, and but I said to him, I'll open up a store in Atlanta, but it has to be done a certain way. It has to be done a different way. One, I'm not going to do any retail. There isn't going to be any walk-in business. It's all going to be wholesale. I'm going to go and I'm going to create a list of clients, and I'm going to find corporate clients, and we're going to deliver to corporate cafeterias, hospital cafeterias, schools, things like that. And so the reason why I did that was, I wanted to create a stable sort of stable business where I knew what my production was going to be each month, and I could just plan everything out and sort of run the business like a production company versus a restaurant. And we did that. It was we were pretty successful at it. It was a lot of fun. I mean, I learned a ton. I learned that I learned to appreciate the HR department in big companies, because not having one is pretty difficult. I don't know if y'all hired folks, right? It's not easy to hire people. It's not easy to fire people. It's not easy to figure out what kind of benefits you can give folks if you can do that. There's just a lot involved. I learned how to work with the government in terms of regulatory approvals, because we were a food producer, not a restaurant. So we were regulated by the Department of Agriculture, and just a ton of hoops to jump through. But I was proud of the work we did, and I did that for about 5 years. We ended up selling sushi to universities in Georgia, University of Georgia, Emory University, Georgia Tech, and we even became the first sushi provider to provide fresh sushi to public school system in Georgia, which was the Atlanta Public Schools. So it was super fun. But
I just want to know, like, in high school, I got these little pizza rolls and they weren't very good. I mean, like, kids getting sushi, that's just not fair.
Yeah, and it wasn't fair. And it was kind of a perfect storm in a good way for me at that time. It was, I mean, the Obamas were in office, and Michelle Obama had that sort of like a healthy food push going on. And so that went through to public schools too. And I learned just a ton about how difficult of an environment those cafeteria managers, I should say, and chefs operate under, because of, they've got to feed each kid the full day. They get like $1.25 for each meal, or not even for each meal, for each day. And so the food that they were buying from me was more than $1.25 per meal, but they were pushing it to get in that additional sort of healthy option for kids. And it was neat because of some of the schools in Atlanta Public Schools are people might consider inner city, and I went in there and sampled the sushi for those kids that had never eaten it before, and some of course weren't about to try it, and others were pretty excited when they did have it, and it was cool to see. But that business, as we're sort of in this situation where right now where we're hearing about how difficult restaurants are having without any business, right? It's all a cash flow business. Margins are thin in food, even for successful places. My margins were better probably because I was just doing production. So I had to manage all that, but it was time to get out of that business after about 5 years. It was time in my personal life. We had my wife and I, we just had a son, and we did our production at night. And so, because we wanted the sushi to be as fresh as possible, and we delivered it in the mornings for lunches. And so, after the fourth or fifth call at 1 or 2 in the morning, hey boss, we ran out of avocados. And I'd have to get out of bed and go to the all night avocado store. That was pretty much it on that. My wife said, we've got to do something about this. And luckily, happily, I'd say because some of it is always luck, but because I did plan ahead, I was able to sell the business, and they've been operating for the last 5 years, and hopefully they'll survive through the pandemic. But
yeah, that's awesome. Well, and I'm also hoping, big things are sending out positive vibes to that all night avocado store. I mean, that seems like pretty niche line of work. So, if there are
yeah, it's a little bit of hyperbole there, but for sure, there's plenty of food service providers that are open all night, because it's a 24/7 business for sure.
Yeah, no, that's really interesting. Well, can you talk a little bit about maybe the process of selling? And then I guess you sort of reverted to stay-at-home dadness, but then sort of getting back into the workforce.
Yeah, no, and thanks. So the sales process it's always similar. I think what you have to do when you have a small business, and I've helped some folks through this process before as well, during a little bit of consulting that I've done. But you have to present, right, to your potential buyer a reason for them to get involved in the business. That reason is going to be cash flow, right? And you have to show them that when you leave, that the business can continue operating with them at the helm. And so for me, I put in a little bit of the investment banker background and created a very in-depth pitch book with all the financials and basically the customer list that was able to show how long everybody was with the company. We had customers that were there with us from the beginning, and so if you show that sales stability, it really is a good selling point for the company itself. And I think a lot of small businesses are sold almost on a handshake basis.
That was me. I went down that road. I bought a business and ran it for 2 years, and we had a 2-year clause in it that said if I wanted to get out at any point, I could give it back to the guy who bought it. And at the end of 2 years, I gave it back because it just wasn't working out. But we had a handshake. We had no financials. We had no, it was like, hey, you want to run this now? Sure. All right. And it's yours. and it wasn't the best decision I ever made, but it was a learning experience.
Yeah. Yeah. Well, I mean, I think in a sense, I got lucky in that my first business of that nature was a positive outcome, as in I could sell it versus just simply closing it down and hoping that the landlord could lease the facility out. So I wasn't on the hook for the other 5 years of the lease. Whereas a lot of people obviously get stuck with the opposite of what I did. But that's when I do work with business owners or even folks that are considering becoming business owners, one of the things that I counsel them to do is to sit down and think about the exit strategy before you even think about how you're actually going to run the day-to-day operations, because that's going to drive how you want that day-to-day operations and your procedures and all that to look like. At the end of your time in the business, whatever that's going to be, are you going to be happy just closing the doors? Like, do you plan on running it till you quote unquote retire? Or are you running it with the goal of being able to sell it one day? All those things, are, if they're not baked into the system at the beginning, it's going to be really difficult.
Yeah, it makes sense.
Yeah, well, so maybe let's take a little bit of a transition. Like we've alluded to, I mean, we are taping now, right, amid crisis in the middle of this, COVID pandemic, but there's all the, financial and economic stuff going on right now. The economy is basically ground to a halt, not just here in the States, but globally. And so I wonder, as somebody with a background in finance, if we couldn't maybe shift our conversation a little bit to, how do we weather this storm? Whether it's through financial planning or through innovation and identifying opportunities, or, whatever strength you've got in this field. I think it might be interesting to sort of talk about this new world and what's going on in it.
Well, and
thanks.
On that same topic, I've heard that now is actually a really good time to invest, just because it's going to do nothing but go up from where it's sitting right now. Can you maybe highlight some of that in your response as well?
Sure. So what I will say is that the financial advisory business is sadly dominated by sales, right? People are trying to either sell products to customers, the products being financial, could they be stocks, mutual funds, you name it, insurance. But even financial advisors such as myself who do planning more so than investment advisory per se, we also have to sell because we're selling our services. We're selling the value that, what's the value of having a financial advisor, sort of on your personal payroll. And the only time that you don't have to sort of work super hard to sell as a financial advisor, I think are in periods like this, periods of extreme disruption, because even though I was not acting as a professional advisor for personal finance 10 years ago during the financial crisis, I got calls from people I hadn't heard from in years. What should I do? You're in this business. Don't you understand? Should I buy? Should I sell? And, over the last month, the same thing has happened. Now it's 10 years in between. None of these people had called me in between practically, right? But I actually got a message popped up on my Facebook feed. It was from a friend of mine, and I interact with him a little bit online. Mostly, he lives in a different state. And I looked at the timestamp on the last message he sent me. It was literally in 2009, and he was asking me what to do with his stocks in 2009 because the market had crashed. He messaged me again. What do I do? And it's so people tend to realize that, right? Like you guys asked, is this an opportunity? Should I invest now? The thing is that none of us know anything. I mean, I have you might be able to see it on the video feed, but I have this this banner behind my desk in my office. It says nobody knows anything, and when my clients see that, I try to. They'll giggle because they understand if they've spoken with me that. I try to tell them that none of us can know what's going to happen in the future, right? We don't know what the market's going to do. My crystal ball is a lot like the Liberty Bell. It's cracked. It doesn't work. So what I want to do and what I like to, help my clients do is control what we can control, right? Think about what you have to deal with, and that includes. In this instance, hopefully having an emergency fund that you can lean on during these times of stress, being allocated correctly amongst your savings and investments as it relates to where you are in life. Because, like, for instance, I've had friends of mine who, in all other periods of time, that I've known them, let's just say for the last decade, they've been big fans of just keep investing, buy and hold, just keep the costs low and invest. And it's worked, right? It's worked because the market's gone up for the past 10 years, basically until last month. And now those same people that had bought into what is basically what you should do, just keep saving, keep investing, and prepare for the point in time in your life when you're going to need that money. They're calling me and saying, should I sell everything? Should I go to all cash? Is the market going to hit bottom? When's the bottom? And I have to keep telling them, I don't know. Do you know? Why would you? And then I ask them a series of questions. Why would you think you knew? And they'll send me these articles on the internet. That are from the internet that tell them that all the doom and gloom articles, right? Yeah. And then I can combat that, but I can send them back an article that's too optimistic as well, right? We don't know what's going to happen.
So how can you how can you just kind of make an informed decision and go, because you don't know, but you've got the doom and gloom on one hand and you've got now's the perfect time on the other. How do you proceed?
Okay, yeah. So the idea would be, in an ideal world, you have a financial plan for yourself that you've thought about. You could make it on your own. There's plenty of sources on the internet for good ways and books that you could get how to make your own financial plan, or you could be working with a financial planner, such as myself. The idea is to come up with a plan that you are happy with, that, again, it works for the period you are in your life. So if you're in your 30s and you're sort of beginning your real savings process, you're finally getting to the point where you're in a job where you're making enough money to save a decent amount, and the market goes down as it does, as it has, over the last month. It makes you nervous, of course. It's disappointing, yes, but you try to remember that statistically these corrections happen every 5 to 7 years. The last bull market of 10 years that was the longest one ever, and historically it has gone back up. Now, any time could be different, right? but what we don't know what would make this time different. So what can you control? You can control how much you're continuing to save. And again, if you're in your 30s, you know you're not going to need that money that you're saving for retirement for quite a bit of time. So if you're double-digit years out from retiring, then you really shouldn't even worry about it, because when you worry about it, you make decisions, right? And this applies to anything in life, not just finance. But when you're making decisions out of emotion versus sort of objective analysis, that's when the mistakes get made. And that's why most individual investors, when they try to pick stocks, they lose. And frankly, it's why most active money managers don't outperform the market either, because they're either forced by their clients to make moves during a down market like what's happening now, or humans can't predict the future. So it doesn't matter how much analysis you do. You think you've looked into a company and that company is going to go to the moon. The chances of you finding enough of those, even if you're right that one time, the chances of you finding enough of them to outperform the market on a regular basis is extremely small.
So what would you say to someone who's scheduled to retire next year? It's actually my dad is scheduled to retire next year, and his 401k took a beating this last couple months. Do you have any advice for anyone that's in that kind of position?
So if you were scheduled to retire soon and the market has gone down, could be any time now, but it is happening now. The first thing I'd say is I would hope that that the risk within your portfolio and how it's distributed was allocated correctly over the course of time, right? So you're not, when you're at 32 years old, you could be 100% in equities. When you're 62 years old, you should not be 100% in equities. You should have a mix of fixed income and more stable, theoretically, I should say, stable savings. And so the idea would be, depending upon that, depending on what your portfolio looked like, right, you should ideally be able to make withdrawals, if you need to make them, from the securities or portions of your portfolio that haven't gone down in value, and then to draw on that while you avoid locking in losses sort of on the other part of your portfolio. And then ideally, retirees, we talk about, I mentioned that the concept of an emergency fund earlier. Retirees should have, because of this exact reason, and it's something they call sequence of returns risk, but it's connected with that. They should have really a larger emergency fund, depending upon how their savings are allocated, because they need to be able to live potentially off of this during a period where the market went down.
Yeah, interesting. I don't know any of their actual numbers or how their funds are set up. I just know that it hasn't been a good couple months for them as far as the retirement.
Oh no!
401k. Yeah,
I've had people call me and say they've been complaining to me. Thankfully, not my clients, but again, friends of mine. I'm going to have to work for another 2 to 5 years because of this, and that's possible for sure. But we don't know. But that could be the case, and it's a sad situation, and I hate to be. I see this as, when I say this, I see this as being realistic, but some people see it as pessimistic. But the thing is that a lot of this is based on luck, right? Luck, timing and luck. So if you are somebody who is going to, like you say, like your dad, scheduled to retire in a year, that's what you were planning on doing, and the market drops by 20, 30%, and you still had a significant amount of savings in the market that you were counting on, to fund that retirement, that's bad luck. No one could have predicted this COVID thing. People in hindsight will say, "Oh yeah, well clearly," and somebody will come out with an article that they wrote in 2015 saying that the next pandemic is the next risk to the market is a pandemic, and but right, we know people are writing these articles literally all the time, and there's the bears are always going to be right sometimes, and the bulls are always going to be right sometimes, but that's bad luck. And hopefully you're in a situation where you've planned for your retirement enough that you can still retire. Maybe you push it off a year, who knows, but if your luck is bad, you're just not going to have the same type of financial resources in retirement as somebody who had really great luck. Somebody who retired 4 months ago and either had their financial advisor or did this themselves, then said, you know what, I'm retiring, so I'm very uncomfortable. I don't want equities risk. And they lowered their equity percentage allocation in their portfolio to 20% or something, that's more applicable for a retiree. Well, then they're high-fiving, right, themselves. But that was just the luck that they decided to retire in December as opposed to April.
Yeah. It's crazy how 4 months can make that big of a difference.
Right. Which is why, not to push too much on it, but it's true, which is why I'm in this business, because I'm trying to help more people plan for all of the potential outcomes, because we don't know which one is going to be the outcome when it's your time to retire, because of your retirement might be voluntary. It might be involuntary. You might be retired by an injury. You might be retired by the company goes out of business. You thought you were going to work till 65. The company goes out of business when you're 61. And hard to find a job, blah, 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 as you get older. But ideally, you're either talking with your family, your spouse. If you don't have an advisor, if you have an advisor, you're talking with them, you're talking with all of them, right? On a regular basis about what could happen. What if this happens? How are we prepared for, these eventualities? Some of which we know are going to happen. Everybody feels that they're going to retire, one day. Most people do. And, but we don't know exactly when that's going to be. We can plan for it. And that's what we can do. Let's do the best job that we could possibly do planning. And then sort of roll with it as it actually occurs.
Yeah, I think that makes sense. Let's maybe transition this conversation back to sort of, I think the studies say something to the effect of most people don't have $1,000 in savings. Most people don't have really any kind of emergency fund or anything like that. A lot of people are check to check. Yep. Let's say now, maybe to kind of circle back to Mike's, question about, buying into the market at this point. Let's say you've got a little money. This has really inspired you to, this crisis has really inspired you to start a savings, start, putting away for emergency, because maybe life was just too cush for the last little while and you didn't realize it could go so sideways. And so you start putting together a savings, you start doing things like, what are some steps that we can do now? There are many people who, of course, have lost jobs or have been furloughed and, maybe money is too tight to really actually start thinking about setting money aside. But are there things like tools like buying into the stock market and things like that now at these incredible lows, and grow a fund more quickly than otherwise? Or, are there opportunities like that out there for people right now? Or is it just fundamental financials, put away 10% of what you make or 20% of what you make, that kind of thing?
Yeah. Okay. So I'm very much a believer that you can't time the market. period, full stop. So like when you say, could you put money away now and grow faster than otherwise? That answer's maybe, right?
Buy stocks
you know,
in Charmin.
Yeah.
right.
Toilet paper size.
Or Zoom. Like if you happen to be a stockholder in Zoom, you're pretty happy right now.
Although I think just to that point, just a funny thing. I read a story the other day that they were saying that people were buying the wrong Zoom.
Yes.
They actually had to stop the account for it, right?
Yeah, everybody was investing in a different Zoom Industries or whatever instead of ZM or whatever the ticker symbol was.
and this is the incredibly sad, hilarious, scary. I don't care what you want to call it, but significant number. And when I say a significant number, I'm talking almost double-digit % of the time, the wrong stock gets purchased. And so it's something as simple as that is another reason why I don't advocate clients or anyone really, but my clients purchase individual stocks, index funds, buying the market. That's how you lower your risk by increasing your diversity. As I said earlier, no one's going to outperform the market. So what you should do is buy the market. Makes it easy to allocate between equities and fixed income, or people call bonds, right? And other types of investments like real estate. Keep everything as simple as possible and as low cost as possible, because of the only way that I know for sure that you could keep more money in your pocket is to not spend that money. Really. So every time you can avoid spending money on a commission or a load on a mutual fund, things like that, that's what you should do. But really going back to your question as to what can people do now, I really think it's a perfect opportunity to take yourself back to the blocking and tackling of your personal financial world, which is, make a budget. See if you've never done a budget before, try to make one for yourself. There's plenty, again, opportunities of online budget software that you can do for free, but you can do it on a piece of paper. It doesn't take that much. How much do you actually spend on food? How much you spend on rent? How much you spend on your car, et cetera, right? Put that together. Figure out how much should you have at the end of the month to save, and then sort of just live a month and find out how much you did have, and is it different? Because a lot of people, I go through this exercise with a lot of folks. I go through it with clients, but I also go through it with folks that I trust. I just try to work with people like old employees from my food service industry experience. They're not typically hiring financial advisors, but they need help. So we'll go through this process. And a lot of times they'll say, well, my budget says I was supposed to have $250 at the end of the month in my account that I could save. But in fact, I had to put another $50 on my credit card. So then we have to, so let's go through it together, right? Step by step. What did you not write down? And not to pick on Starbucks or lattes, because there's been plenty of articles about that, right? Don't buy the latte and you could be a millionaire. And then the one that somebody wrote, say, just buy the damn latte, right? But it's all true. You'll find there are things that you didn't know you're spending on, and maybe it's perfectly fine to spend it on it. Maybe it's that coffee is the thing that gets you going every morning, and without it, you'd be sad. Your work would be bad. You'd yell at your wife. Who knows, right? And so that's fine. It's just a matter of figuring that out, and then like I said, the blocking and tackling, laying that foundation. The emergency fund is super important. To suggest that you should invest in, a risky asset before you have something like that, a stable emergency fund built up. I don't think I could. That's not something that I would recommend, because you can get into a spiral pretty quickly. Debt spirals happen to folks, and once you're sort of below water, it's really hard to climb out. So the first thing, that I would recommend is try to stay above water, and then start, building from there.
There's obviously higher risk investments versus lower risk investments. Something that I've been studying lately has been investing in life insurance and using it as a almost like a family banking system where you can invest into the life insurance and withdraw if you need it, if you want to buy a car or something like that. Sometimes using that to buy a $10,000, $15,000 car, you eliminate the interest rate, and as long as you kind of make the same payment that you would to a lending, like a bank or a credit union, you just put it back into your insurance. It's almost like a revolving account where you get what you need, but you put it back, and it's an interesting thing that I've been looking into recently. Is that something that you would recommend to a client of yours, or are there other?
Yeah, it's interesting that you should ask that question. So that you mentioned buying a car, because I think car salesmen are well known at being good, especially used car salesmen, right? The stereotypes of how good they are at getting people to buy stuff that they might not need, the extra rust proofing, the undercoating, and the special shine on the wheel. So the insurance industry is probably, they might have the best salespeople in the entire world, and they're so well trained, and they can convince you that this might be a good idea to do what you're saying. And you can find books on this. You can find videos on YouTube and all this stuff. Be your own bank, infinite banking. They have all these.
It's a YouTube names. Video that I watched, and it's like investing like the Rothschilds, and it's like,
yes. So I mean, I'll give you a little bit of just the smallest rule of thumb. There are times where what they call cash value life insurance could be applicable for someone to use, but an easy rule of thumb is to think, well, it's usually good for people who are worth probably more than $20 million, because then they might be able to take advantage of them. There are some tax aspects of that product that they could take advantage of, but it's basically the most expensive way to purchase insurance, and you're paying for all of these other possibilities or tools that they're talking about, like borrowing against the cash value and all that kind of fun stuff. It's super expensive. You could find a cheaper and more effective way of doing everything that you would do there. Term life is great. Everybody should have life insurance if you have dependents, or if you anticipate
I've heard that
having them.
Like term life is actually kind of a risky way to go, because you essentially have to die the way that they want you to. Almost like if you. You've been listening to some really good YouTube videos. I need to get this guy selling my business. He would probably do better than I do. I mean, there's a little bit of truth to that, just in the sense that statistically, the vast majority, 88%, maybe more, of insurance policies don't pay out. Life insurance policies, but that's just because on the cash value side, many people just give up paying. And once you stop paying, the insurance will get canceled eventually, right? If you built up cash value, then perhaps that cash value will be used to pay the premiums for a while, or you'll just withdraw that cash value, and the policy will go away. Or if you bought a
a 20 or 30-year term life policy to work for you, to be there to protect your family while during your working years where you would otherwise be providing for them. Once you get to the point where your family is independent of you, then there's no need really to have that insurance anymore. So you drop it. So most insurance, it's true, doesn't pay out. The idea that you have to die a certain way, I'm not sure. I bet somebody would come up with some really good examples, but most insurance companies, once you've gotten past the point where there's a certain period of time where they could question you because if they're worried about fraud and things like that, once you get past that point, they pretty much pay out because of it's not in their best interest to fight it. It's a PR. It's a PR game. But I very much caution anybody from looking at cash value policies as an investment. If anybody tells you that your insurance policy is an investment, ask them how they are getting paid. And that's a big question, for everybody in the financial industry, financial planners, advisors. A lot of advisors are insurance agents, and they'll call themselves financial advisors, and their goal is simply to sell cash value insurance policies and annuities, because those insurance products pay the highest commissions of almost any financial product. So, it's you think about it again. Use a rule of thumb. Generally speaking, your commission on an insurance product is going to be about a year's worth of premium. And so, if you were doing and it's going to be 10 plus times as much as a term policy would be. It's just, people are going to, the salespeople are going to act in their best interest. Their best interest is to sell you the product that gives them the greatest commission. And of course, insurance agents aren't required to be fiduciaries or act in the best interest of their client. They are required not to cheat people or lie, but at the same time, it's a lot different than a fiduciary requirement.
Well, it's almost like a loan officer giving you a higher interest rate because they get a couple points kicked back in the back end that you don't see because
that's exactly it. Sadly, that's exactly it. And so that's what I was saying. The question that you have to ask whenever you work with any of these folks, me as well. I encourage people to ask, although it should be super easy for them to find out. My fee is right on my website because I'm a flat fee financial advisor. So basically, everyone gets charged the same amount, and they know it every year. And it doesn't matter whether they've got $500,000 or $5 million because of the amount of work that I'm going to put in to help them with that process is going to be the same regardless. And it's not in their best interest for anyone to charge them more to do the same job simply because they have more money. And so a typical structure of financial advisory is what they call the assets under management fee structure. If you guys are familiar with that, but it's pretty simple. They look at how much money these people have under management, and they charge them a percentage of that money, typically somewhere around 1%. And so, for a $500,000 account, right? Somebody makes, $5K. Okay, that's I don't call that fair, but I've decided that's my fee. $5,000 is a reasonable fee for someone to pay for comprehensive financial planning and investment management. That is annually. But then what if the person comes into a great aunt that they didn't know existed dies, gives them $1 million, and now they hand me another $1 million to help them through? Did that make their planning, that process that I go through with them, any more complicated? Really? No. We're going to invest it in a similar fashion. Probably, yes. So why should I charge them $15,000 now? I shouldn't, and I don't, right? And so it's the same thing. So if you ask a financial advisor, how do you get paid? And, some of the insurance salesmen, financial advisors will say, well, I do this planning for free. It's just part of it. And they'll give them different tools to explain it away. Say, the planning is free, but we'll work together on certain things, and I'll be paid by the insurance company or something like that, right? If we do this type of transaction, if I sell you this index universal life policy as an investment, and they'll tell you how great it is, right? You can borrow against it and everything. Then they'll tell you, well, the insurance company is paying for it. Well, the money goes through the insurance company, but it comes from the client. It's all about figuring out how is the person on the other side of the desk from you or table, how are they getting paid? Are you comfortable with that? Does that make sense to you? And can you figure out that whether the way they get paid gives them an incentive to do something that might be more in their best interest, right, than your best interest?
Yeah, no, I think that's really interesting. And I wondered too, just as we're starting to get towards the end of this, I wondered, we've talked a little bit, and I think this is kind of the tip of the iceberg on trying to identify a potential financial advisor. But do you have any other advice or other things that we might look for in a financial advisor? Clearly, everybody can have a YouTube channel. Everybody can have a social media presence. Some people are great marketers. Some, we're for people who don't know anything, it's a pretty scary frontier, right? Because you can just walk into it and basically anyone can take advantage of you if they happen to be a little smarter than you. So, or if they happen to know something you don't know. And so I wonder if you had some other pointers on how to find the right financial advisor or find somebody that you can trust.
So the internet, like we talk about social media, right? It has its positives and negatives, right? Anybody can get on put a YouTube channel together, and if they buy the right production equipment, they can sound and look good. And if they're talented, right, they could really convince you that their way of doing things is the right way. That's a negative. The positive is that there's more information out there about how to avoid making mistakes and how to choose the right people that you might want to work with. And so some great sources are, if you want an old-fashioned paper book, although you probably can get on a Kindle as well. You look for anything from Jack Bogle, who is the founder of Vanguard, and one of his greatest and easy reads is a simple guide to investing. He'll tell you, sort of why you can't beat the market and go through that whole process. But anything by Jack Bogle, there's a forum, there's a Bogleheads forum that a person could join. There are communities that have built up around the concept of financial independence over the last number of years. You can go and search some of those out. I'm a member of a lot of any number of them, but ChooseFi is a great group, and people will give you really honest advice about who to work with and who not to work with, and so you can avoid that. I think easier than in the past, because in the past it was pretty difficult to figure out how people were getting paid and what they were doing to get your money and things like that. I think a little bit of research goes a heck of a long way nowadays.
I think a lot of it actually kind of goes back to referral based too. Who did we have on a few weeks ago that was the banker from Canada? That was her recommendation, is just ask a friend who's investing already and doing the right things, who do they use? And I would think that a lot of that comes back, because if they're getting good service, then it's saying something.
Well, I know that. I mean, we don't have a financial advisor at this point, but we do have a bookkeeper and a CPA, and both came that way. So
yeah. So the funny thing is that while I do get business from referrals, and I hope that will continue. It's kind of a weird thing because most people like their financial advisor, unless they figured it out that their financial advisor has taken advantage of them in some respect, right? So if you ask them who they have, they're also they're not going to really probably tell you, well, yeah, this guy, I mean, I'm not sure if I really get my money's worth, I don't know how I pay him. The vast majority of people don't even know how much they pay their financial advisors every year. It's a weird business. I like it because I can help people, but I avoided getting into it for a number of years just because there's so many opportunities for people to frankly get taken advantage of. And so referrals are weird, right? Because no one wants to think their doctor was the one that graduated last in the class, right? No one wants to think their financial advisor is one of the guys that's just putting you into an investment because it pays him better than you. And so people have a capacity for ignoring stuff that they don't want to know. Yeah. And also, frankly, their advisor, their doctor, the doctor with the bedside manner, the financial advisor with the really great personality. I mean, that's going to potentially result in a referral, but it might not be for the best reasons.
Yeah, no, it's true. Well, and it is hard to know. I think, like you said, good research and taking your time to really investigate these things, have some understanding of, what it is you're trying to accomplish maybe would be useful. And, and then finding the right guy to do that kind of work.
Yeah, for sure. I certainly don't want to leave people with the impression that all these folks are sharks and out to get them, although there are enough of those. If you exist in an industry where everybody does the same thing the same way, it's been done that way for half a century plus, then you're probably not worried about it. You're not even thinking about it. You're like, oh, okay, this is great. I charge my clients a percent, of their money every year. It's a great business. I provide them with a good service. That's exactly what the guy sitting next to me in the office does, and the guy down the street, and everybody at whatever big New York bank, they're doing it. So you're not thinking about that. I think that's what it took me to get on a different page and to do it differently was stepping away from the industry for 5 to 8 years to see that, if I wanted to go back in, how could I go back in? Sort of the same way how I decided to go into the sushi business, to really take a very high look at the whole thing and say, how could I go into this feeling comfortable with myself in terms of being able to sleep at night, and then doing the absolute best thing for my clients, as opposed to, how can I make the most money at it?
So I guess in parting, we're almost at that time. How can someone, I work in the entertainment industry and as a DJ, and a lot of my peers don't have any retirement, don't have any type of savings, they're literally the people who are currently unemployed because of COVID-19, and they have no money right now.
Right.
How can someone in that position start? Is there, do you have any recommendations for someone who literally has nothing, is starting to realize that, oh crap, I don't have anything, I don't have a way to retire in 20 years, and 20 years goes quick? What's a good starting point for someone like that?
Starting point is sort of the most basics again. Figure out your budget, figure out how you can save money. Get some amount of money, if you can. I mean, I know that I've worked with folks that aren't able to save at the end of every month, and it's just because of their situation in life. But if you can even just have a target and say, okay, well, in 24 months, my income will be this. If I keep my expenses the same and I've grown my income, I can then save, right? And if you work towards something, like we're humans, humans need a goal to be able to accomplish something. Usually, it's very hard for it to just happen accidentally. So if you have that goal and you're working towards it, it's less. There's less of a chance that you're going to get disappointed along the way and just say, forget it, I'm never going to save. I might as well just, buy the next shiny toy because I'll never be able to retire. And then start with the absolute simplest things. Again, try to build up first that emergency fund so that you don't have to go into high interest rate debt on a credit card or even a payday lender if you run into problems. And once you have that, put it away for an emergency. Don't spend it on Christmas gifts, the next year. And then, just go to a bank and open up an IRA. Heck, you could do it online right now, but try to take advantage of any sort of opportunity to use tax advantage products, to any qualified retirement products. Because of, again, if you're looking for ways that you can save money, well, not paying taxes is like having a guaranteed return, right? Because again, anything you don't spend is better than spending it. Not paying the taxes is better than paying it. And so, but the key, frankly, a lot of people, we can play around at the margins with, is this thing slightly better tax-wise than this other thing? Should we do a Roth IRA? Should we do a regular IRA? All these different things, right? The key is really just developing some personal discipline and actually saving. I totally understand that it's difficult. It's difficult for most folks, right? Because even high income, there's a huge percentage of six-figure earners who live paycheck to paycheck. It takes discipline. It takes not paying attention, to the guy down the street who just got the new car or motorcycle or whatever, right? But it's, it doesn't take long for it to start paying off.
Yeah, keeping up with the Joneses is pretty expensive.
It really is. Those Jones, man,
they're doing real well. Well, cool. So I guess then in closing, you want to just tell us where people can learn more about you, John, where they can find your website and do any other research on you?
Yeah, sure. So I am, for better or for worse, all over social media. My wife probably complains about it a little bit, and if I was working for a large institution, the HR department might even yell at me. But that being said, my handle on a lot of platforms is Stoy Boy, and that goes back to my name being spelled Stoj. However, it's pronounced Stoy, like boy. And so my handle is actually STOJBOJ, and I made a joke out of it, Stoy Boy. And you can actually get to my personal website like that. You can go to stoyboy.com, STOJBOJ.com, and that will have a link to my financial company's website, which is Verbatim Financial. You could also go to verbatimfinancial.com, but it's a lot more letters to type. So I could tell people to just go to stoyboy.com and they'll find anything they need about me and my company.
Great. Well, that's awesome, John. I really appreciate your time and taking the time, especially during crisis. Before we got on the air, you explained that you had to basically pack everything back up from the home and bring it back to the office so you could do this call. So we appreciate the sacrifice and doing that for us. We really appreciate it.
No, I appreciate you guys. It's a mutual appreciation society here. But no, thank you guys for having me on. This was great. And I hope, if we get a chance to talk to each other again sometime in the future, we'll be through all of this COVID stuff.
That'll be great. Cool. Looking forward to it. So thanks to everybody who tuned into the show, listening this week and every week. And check us out, eggscast.com. feel free to get involved on the show. We've got a form there on the website you can fill out and leave questions, comments, things like that for our guests, and make suggestions for future guests. And with that, I guess we'll see you next time. Stay safe.